Hello everyone, I'm Marie Bagunu. Welcome to another episode of Jersey Pads TV. Today we're going to talk about mortgages. I know, you're very excited, right? No, not so much. Well, I know mortgages can sound complicated, but I'm here to simplify things. Today, I'm going to talk about 5 mortgage terminologies that you should familiarize yourself with so that you'll be very comfortable talking to your lender. Let's begin.
APR.
Thank you, Gabriel. Annual percentage rate, or APR, is the actual cost of the mortgage loan when stated as a yearly rate. Now, I want to talk about this because this is different from the interest rate. The interest rate is the base rate. It's the standard rate. Say, for example, you got 3% interest rate. Then you paid $3 for every $100 loan amount. It's very straightforward. However, the APR includes a lot of different costs and charges, that is involved in the mortgage. For example, loan origination charges, you have closing costs, you have points. All these other things are incorporated into the APR. So in fact, the APR is actually a truer representation of your actual cost. Points. You're gonna hear this term a lot, so listen carefully. Points are fees directly paid to the lender at closing in exchange for a reduced interest rate. 1 point is equal to 1% of the loan amount. For example, $1,000 for every $100,000 loan. Now, it all depends upon you really, whether you want to pay more upfront or kind of distribute it as a monthly payment through the interest rate. Obviously, the higher interest, the higher monthly payment you have. So it depends on whether you want to pay more upfront or spread it over the life of the loan.
PITI.
Thank you, Gabriel. Gabe's learning all his letters and now he's such a show-off. PITI stands for principal, interest, taxes, and insurance. Now, principal is that part of the mortgage loan that slowly gets paid off as you make each monthly payment. So it gets reduced over time. Now, interest, on the other hand, is the cost for borrowing funds. Taxes refers to property taxes and insurance to homeowners insurance. It's pretty much straightforward. Now, all of these 4 lumped together is what you would call your monthly housing expense. Closing costs. These are costs necessary to transfer ownership of property so you can close the mortgage loan. Now, these can be paid by the buyer or the seller, or maybe, shared by both. It really depends on how you negotiated the deal. These costs include attorney fees, title insurance, survey, lender's origination fees, all these other fees that you need to pay to close the loan. So remember, when purchasing your first home, you need to have enough funds, not just for the down payment, but also for all your closing costs.
PMI.
Private mortgage insurance, or PMI, is an insurance policy that guarantees the payment of a conventional loan in case of default. So usually the lenders only require this when you pay less than 20% of the purchase price for your down payment. If you pay above 20%, then there's no PMI. Now for an FHA loan, they have a different term for it. They call it mortgage insurance premium, or MIP. So PMI, MIP, it's essentially the same thing. All right, let's do a recap. We learned 5 mortgage terminologies today. Annual percentage rate, or APR, PITI, which stand for principal, interest, taxes, and insurance, points, closing costs, and private mortgage insurance, PMI, or MIP, mortgage insurance premium. There's so much more things to learn about mortgages, like conventional versus FHA, fixed rate versus adjustable rate 5 years, 7 years. There's so many things. But meantime, I hope you learned a lot today with the mortgage terminologies that I told you. And think about it, sleep on it, and I will see you on my next video. Thanks for watching. PITI, which stands for Principal, Interest,